Did you know that nearly 90% of all investors lose money in the stock market over time? It's shocking, but true. Most people focus so much on buying stocks, they forget one crucial part: knowing when to sell. Warren Buffett, one of the greatest investors of all time, has made billions by mastering this art. He's not just a buyer, he's a seller, too. But here's the thing: Buffett doesn't sell like most people. He doesn't panic when the market drops, and he doesn't chase after every trend. Instead, he waits for specific signals. These signals have made him rich, and they could help you avoid costly mistakes. In this video, we're diving into the 3 times when you should sell a stock according to Buffett. We'll uncover unique insights from his investing playbook, including why you might be holding onto stocks way too long, and how to fix it before it's too late. Stick with us, and you'll learn how to make smarter, more confident decisions with your investments. Ready to unlock the secrets of when to sell? Let's get started. Chapter 1. The Silent Alarm. When the business you bet on starts fading, Warren Buffett is known for investing in businesses with a strong competitive advantage, but what happens when that edge starts to weaken? When you first buy a stock, you believe in the company's potential, its business model, and its ability to grow. But sometimes, the fundamentals change. The company's moat, the thing that protects it from competition, starts to erode. Buffett often says, the stock market is a device for transferring money from the impatient to the patient. If the business you invested in is no longer the strong player it once was, it might be time to sell. Consider the example of Kodak. At one point, Kodak had an iron grip on the film photography market, but they failed to innovate in the digital age. As their moat disappeared, the company's stock took a dive. If investors had paid attention to the signals early, they could have avoided huge losses. As a value investor, you have to be willing to admit when your original investment thesis no longer holds. Sometimes, the best move is to sell when the business you believed in starts to fade. Chapter 2. The Value Trap. How overpaying can turn a bargain into a burden. Buffett's first rule of investing is simple: buy a business, not just a stock. But it's also important to pay the right price. Many investors make the mistake of buying what seems like a bargain, only to find out they paid too much. This is what Buffett calls the value trap. Buffett has always warned about the danger of overpaying, even for the best companies. He once said, "Price is what you pay, value is what you get." If you buy a stock that's overpriced, it can quickly turn into a burden, even if the company is strong. A classic example of this is the 1999 tech bubble. Investors were buying stocks in tech companies at sky-high prices, believing they were bargains. But when the bubble burst, many saw their investments crash by 70% or more. To avoid this trap, always calculate the intrinsic value of a company before buying. If you're paying more than what the company is worth, it might be time to sell before it's too late. Chapter 3. The boring is beautiful. When simplicity trumps complex speculation, Buffett has always favored simple businesses, companies with straightforward models that are easy to understand. He's not interested in the next hot trend or complex business structures. His focus has always been on finding companies that do one thing well and do it for the long haul. This is why he avoided tech stocks in the 1990s and 2000s. The business models were often too complicated for him to fully understand. Instead, Buffett stuck with businesses like Coca-Cola and American Express, companies with simple, reliable models. If you find yourself holding onto a stock because it's complicated or speculative, it might be time to sell. Buffett's advice: never invest in a business you cannot understand. When a company's business model becomes too complex or unclear, it's no longer a good fit for a long-term investor. Stay focused on simple, proven businesses with clear growth prospects. And if the complexity becomes too much, it's time to cut your losses and move on. Chapter 4. The Opportunity Cost. When your cash is better spent elsewhere, opportunity cost is a core principle in investing, and Buffett uses it to his advantage. He knows that capital is limited, so it's crucial to allocate it where it will get the best return. If a stock you're holding is no longer the best option for your portfolio, it might be time to sell and move that money to something better. Buffett once said, "The best opportunity is often the one you don't see coming." If a new opportunity arises, one that offers a greater potential return than your current stock, it's time to sell and seize that opportunity. A perfect example of this is Buffett's decision to sell his shares in American Express in the 1960s. At the time, it was one of his favorite stocks, but a better opportunity came along in the form of See's candies. He took the capital from American Express and invested in See's, which turned out to be one of his best decisions. If you find a better opportunity, don't hesitate to sell. It's about maximizing your capital, not just holding on to something for the sake of it. Chapter 5. When your gut stops trusting the management. The key to exit. Buffett often emphasizes the importance of a strong management team in any business he invests in. He believes that great management is the key to a company's long-term success. But if the leadership starts to falter or make poor decisions, it's time to reassess your investment. He once said, "I look for a company with a trustworthy and capable management team that I can rely on." If you lose trust in the people running the company, it's hard to believe in the stock anymore. Look at what happened with General Electric. For years, GE was one of the most admired companies, but under new leadership, it lost its way. Investors who ignored the warning signs and kept holding onto their GE stocks suffered significant losses. Trust in management is crucial. If your gut is telling you that something's wrong with the leadership, it might be time to sell. No matter how strong the business model is, poor management can destroy long-term value. Chapter 6. The bubble burst. Timing the market with a value investor's lens. Bubbles are a part of the market. They happen when irrational exuberance pushes stock prices far beyond their intrinsic value. Buffett has seen this happen many times throughout his career, from the tech bubble to the housing crisis. And while he's not a market timer, he knows when to sell before the bubble bursts. Buffett once famously said, "You only find out who is swimming naked when the tide goes out." This means that when the market crashes, only the companies with real value will survive. If you're holding onto overpriced stocks, you're at risk of losing a lot when the bubble bursts. The dot-com bubble is a perfect example. Many tech stocks were overvalued, and when the bubble popped, investors saw massive losses. Buffett avoided most of these stocks, staying true to his value investing philosophy. While timing the market perfectly is impossible, Buffett knows when to step aside. When the market becomes overly inflated, selling off overvalued stocks can protect you from the inevitable correction. Subscribe reminder if you're finding these insights helpful. Don't forget to hit that subscribe button. Stay tuned for more strategies on how to navigate the stock market with a value investor's mindset. You won't want to miss what we have next.